Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, February 12th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is the disinflation process still intact? Our answers are yes for now, but if with emphasis on for now, because we have a highly non-consensus view that core PCE inflation will bottom in Q1 and begin a multi-quarter uptrend in Q2. Both the Fed and Wall Street economists' consensus currently have core PCE persistently decelerating throughout 2025. Our hawkish inflation outlook was corroborated by the January CPI data, which were admittedly and likely flattered by post-COVID seasonal adjustment discrepancies. Our secular inflation model aims to gauge the impact of structural changes in the U.S. economy upon the equilibrium rate of core PCE inflation. Since the inception of the model, when we introduced our sticky inflation theme in January of 2022, it has signaled that the equilibrium rate of core PCE inflation is in the high twos, low threes. Our grid model is calling for core PCE inflation to bottom in the mid twos before cycling higher, like cyclical processes always do. That is consistent with our industry-leading deep dive empirical study on U.S. business cycle dynamics that confirms there is zero evidence of inflation breaking down durably below trend without a recession. That same model continues to assign a low probability to a developing recession in the U.S. economy. All told, investors should expect better behaved inflation data for the next few months. By the summer, however, we believe the consensus narratives regarding the disinflation process and the degree to which monetary policy is restrictive will change. While rate hikes are unlikely over the medium term, a dramatic hawkish revision to the Fed's estimate of neutral is an underpriced risk for the bond market and, by extension, risk asset valuations in the second half of 2025. Transitioning to our 42 macro dashboard, as always, to wrap up the question from our community, says thoughts on the reverse repo hitting the lowest level in almost 5 years. So a few thoughts. One, this was very deliberate. Recall that Secretary Yellen, to Treasury Secretary Janet Yellen, was concentrating issuance on the short end of the Treasury curve to satisfy excess demand in the marketplace and among commercial banks for shorter duration Treasury securities. And so that allowed a lot of that excess liquidity, which had fled duration risk in the bond market and got wound up on the Fed's reverse repo facility, that all that excess liquidity was able to kind of get freed. I mean, we're basically down about $2.4 trillion from the height of the RRP, I want to say in late 2022 or early 2023. So one, it was deliberate. Two, what it is an indication is that the excess liquidity in the U.S. financial system is getting to a level where it's no longer likely to be excess liquidity. Now, there's two layers of excess liquidity. One, the excess liquidity that we can see show up on the Fed's reverse repo facility that does not have a home in shorter duration instruments, either in the repo market or in the bill market. But there's also the excess liquidity in terms of the spread between adequate reserves and ample reserves. The Fed has been very reticent to define exactly what that means in nominal terms or ratio terms. So we as investors have to use a myriad of analyses to kind of figure out and gauge that. And so right now, the Fed still thinks it's in an ample reserves regime. It's trying to go to the Fed thinks it's in a I want to say ample reserves regime, wants to get to an adequate reserves regime, and ultimately our ability to fill that out as investors, will be a function of us being able to spot changes in repo market dynamics, pricing in the repo market. Typically when you see spreads right now, the spreads between general collateral repo, for instance, and the effective Fed funds rate is negative. Like the Fed funds rate is hhigher than the spreads you're seeing in the repo market, which ultimately means that there is excess liquidity in the repo market, because otherwise you would be able to see that spread be positive. And so, we're tracking things like that. We're tracking the RRP to figure out, okay, when are we going to get to a quote unquote ample level of reserves that causes the Fed to stop quantitative tightening. It's our expectation, alongside the expectation of primary dealers in the Treasury Borrowing Advisory Committee, that the Fed stops QT or balance sheet runoff. They're not doing QT. They'll stop the Treasury portion of balance sheet runoff in the summer of this year, and likely continue on with the mortgage-backed security portion beyond that, because they have already stated their intention to get MBS off their portfolio. So it's going to be a while before they do that, given the lack of prepayments in the mortgage market, but that's a totally separate conversation. So in summary, we're running out of excess liquidity. Liquidity is still relatively ample, just judged by the fact that the Fed still believes liquidity is ample. We can observe this through other metrics in the repo market as well. But ultimately, we're going to be getting to a place where the Fed needs to stop balance sheet runoff in the coming quarters. Our expectation on that is in the summer. So hope everyone enjoyed that. We'll catch you back here tomorrow. So Darius Dell presenting our macro minute for Wednesday, February 12th, 2012. Best of luck out there. We'll catch you back here tomorrow. Cheers.